Guys, good evening and welcome to today's lecture. We have some standards to go through and about 4 or 5 of it, and we want to use this class to, catch up as much as we can. So tonight we are going to look at our first standard being IFRS 16 leases. All right, so how we usually go about it is to define the concept here. So we are going to talk about definition. Then we will go on to talk about the recognition, measurements, and stuff. But when it comes to leases, what we are going to do here is to get the underlying understanding in the form of the definition. So what is a lease? We say that a lease is a contract. It's a contract. Or it can be part of a contract. And this contract conveys or conveys the right to use an asset. For a period of time in exchange for consideration. So that is basically what a lease is. What you need to take key note of is that it is a contract or part of a contract, but most importantly, it conveys the right to use an asset over a period of time in exchange for a consideration. These words are very important in trying to understand the lease concept. Now, in every contract, there are two parties to contracts, all right? And here in terms of lease, we have the two parties being the lessee or lessee, and the other party being the lessor. So these are the two main parties. Now, concerning a lessee is actually the entity or the party, or let's say the entity that actually obtains the right of use. That obtains the right of use. Of the asset in question. Okay, so we say the underlying assets. Okay, so the lessee is actually the one who gets to use the asset, and he's the one that gives the consideration, all right? That gives the consideration. Okay. Now let's come to who the lessor is, all right? The lessor is actually the one who provides the right of use. So we say the party or entity that provides the right of use. All right. And the right of use of the underlying assets in exchange for a consideration. Okay, so that is it. You hear words like the time, so is a time factor to it. For example, take it as you going to rent somebody's house, all right? And I mean, the person is actually, you sign a contract, all right? It may be part of the contract, but herein you signed a contract, and the contract is to give you right of use to the room that you rented, all right, over a period of time, and you are going to make payments, okay? So that is it, all right? So all these things about the right of use here that we are talking about. So the right of use, probably a new word that you are encountering or a new phrase that you are encountering, actually is the lessee's right, all right, or the lessee's right. The lessee's right to use the assets, right, to actually use the assets, okay? So, I mean, the right that you have to actually stay in the room and, I mean, paint the room with the colors that you want, anything that you want to do with the, I mean, the assets. It's on you. It's actually based on you to go through that, all right? So that is that. That is that. Okay. Now, to recognize that something is a lease, I want to come up with a table that I've done to enable you identify if the thing is a lease. So I want to refer you to this table that I've done here. Okay, so to sum everything up here. So we say that this is the description of what IFRS 16 has given us. Okay, so we say IFRS 16 says that a customer does not have a right of use of an underlying asset if the supplier has the practical ability to substitute an asset for an alternative, all right? And if it will be economically beneficial for them to do so, okay? So, I mean, if technically what we are saying is that you should have some control, a right to use the asset, okay? So, I mean, if you don't have that, then technically it is not a lease, okay? Well, when we are talking about a lease, what we mean is that you have control, okay? So to be able to identify whether a contract is a lease or not, here is what you go through to find out in this simple tabulated table that you see here. Okay, so all that we are saying is that number one, there should be a right to control, all right? Right to control the use of the asset, okay? So we say that in this, we are trying to say that you obtain substantially or economic benefit from the use of the asset, okay? So you are the one that controls the use and you are the one that is the beneficiary to the economic resources embodying the asset, all right? So that is that, okay? And you need to have a direct use of the asset and that symbolizes your control, okay? So that is that. So herein is the recognition aspect, okay? What we are trying to use this table to discuss is the recognition of a lease, all right? Certain things that should come up for you to know that something is a lease, a contract is a lease, is that there has to be a right to control. Now, but what do we mean by that? We mean that all economic benefits embodying the asset will flow to you, okay? So that is that. And you should be having a direct use of the asset, okay? So that is that. And we are saying that there should be an identifiable asset. You should be able to identify the particular asset, okay? Now, if you are not able to identify the particular asset, then it means that the contract is not a lease, okay? All right, so that is what we say. So, I mean, it has to be stated in the contract, whatever asset that you, and key and importantly, watch this because these things can confuse you in your exam. Now, once the thing is a lease, then it means that the lessor, the person who gave it out, has no substitution right. All right, so that is what we mean. He has no substitution right, okay? And so we say that a similar asset cannot be used instead of the original asset, okay? So please take note of that. And we say that there has to be a timing to it, okay? You remember when we were defining the lease, we said that it is a contract or part of a contract that conveys the right to use. The right to use herein is the control that we are talking about. Right to use what? An underlying asset, okay? So it has to be identified. The asset has to be identified. And we also said for a period of time for consideration, okay? But the period of time is also important here, all right? So that is what we are. So we say that we are talking about the lease term, all right? The lease term. Okay, so these are things that should be made manifested for you to realize that something is a lease, something is a lease. You have to be able to spot that, all right? So that is very, very important. Now, with this concept of identifying the lease, there are like some 3 questions I want us to go through quickly before we move on to the measurement. Everything about lease is at its measurement, okay? So let's just look at this illustration, then we move on to the measurement. All right, so let's look at this illustration. All right, the illustration goes like, and of course, I'm a Liverpool fan, a proud one, of course. Sadio Mane leases a machine to Firmino under a 4-year lease, and Firmino elects to apply the low value exemption. All right, so we will come back to the exemption. There are 2 exemptions embodying this. Number 1, we are talking about low value. The low value exemption. And number 2, we are talking about short-termism. We are talking about short-termism. Okay. Now, what these things are about is simple. When it comes to low value exemptions, so what the standard is trying to say is that leases does not actually specify the particular monetary amount below which something should be considered a low value, and such that you can treat it straight away, not necessarily a lease. Okay, that is that. But the in every country has its own basis. Okay, I think in the US they have like $5,000 as a guide, but every country has its own. Okay, so depending on the value of the thing, you can actually elect to treat that thing as a low value exemption, and therefore you not treat it as a lease. Okay. For example, if you are going to rent somebody's building, normally befits lease recognition and measurement, and the value is, say, you rented a thing for, let's say, 1,000 Ghana cedis. I mean, this value is so low to treat it under the concept of lease. So whatever it is, you can post it as an expense directly. All right. So that is that. Okay. So we have things like tablets. We have small computers, telephones, and we have some small furnitures. All right. All these things can be treated as an exemption of a low value. So that is one that Firmino elected to treat, okay, as the asset. Now we have another one called short-term. Okay. So here we are saying that if the thing is less than 12 months, I mean you can elect to treat the thing as a short-term concept. And in these cases, I mean, you, the lessee, can choose to recognize the lease payment that you made in your P&L, maybe on a straight line basis. So there will be no lease liability, there will be no right of use, therefore, to be recognized in your SOFP. All right, so that is that. So these are the two exceptions around IFRS 16 leases. Now let's come back to our question. So it says that Money leases out machine to Firmino for 4 years, and Firmino elects to treat it as a low value exemption. All right, so it means that we will not go through the lease stuff. All right, so it says that the term of the lease that annual lease payment of 2,000 is payable in arrears, meaning that technically we will be paying 2,000 multiplied by the 4 years to give us something like 8,000. All right, but it says that as an incentive, Money gives Firmino a rent-free period for the first year. All right, so it means that he will not be paying one out of these monies, and therefore will be paying a sum of 6,000 for a 4-year lease. All right, so what is going to happen is that you are going to have a 6,000, but it's for a 4-year lease. All right, so you have 6,000 over the 4 years. I think this should land us like 1,005. All right, so instead of 2,000, we are landing at 1,005. So that is how it looks like. Okay, so that's that. I want to go through and bring up a question which we will use to test ourselves if we can identify a lease. And in terms of identifying a lease, these things must come to play. All right, these tabulated things that you see here must be kept in mind and be used to identify a lease. Okay, so let's look at the question quickly and let's go straight to the measurement of a lease. All right, so let's look at this. It says that James Miller enters into a contract with an airport manager to use some space in the airport to sell goods from portable kiosk for a 3-year. So we have the period. Mena owns the portable kiosk. The contract stipulates that the amount of space and states that the space may be located at any one of the several departures within the airport. Now, the airport manager can change the location of the space allocated to Milner at any time during the period of use. The cost that the airport manager would incur to do this would be minimal, and there are areas in the airport that are suitable for the kiosk. Now, immediately you see this. Let me just go back for you to see the table again. I mean, this one will help us. We say, most importantly, we say that the lessor has no substitution right, like a similar asset cannot be used, right, instead of the original one. Okay, so that is that. And when you come here, let's go back to the question. You realize that inside this question, we said that the person who is the lessee should have a direct control. But you see here that they said that the airport manager can change the location and space of the space to Milner. All right, so that is that. And this one means that the lessor is actually in control since he has influence, all right, of the location, all right. And because we really don't know where the close is situated, the location that has been granted onto Milner as a lease, it is very hard. So we say that to identify the assets, all right, identify the assets. And that one will mean that since we are not able to identify the asset and it looks like lessor is still in control, this contract is not a lease. All right, so that's it. Okay, so that is it. So these are how you identify. You need to watch the table clearly and know that the control is in the hands of the lessee. He has a direct use of the asset, which is very, very important. Okay. Yeah, so that is that. That is that. So let's move to the measurements of a lease, the measurement. Of course, the measurements, we will have two, as we always do. There is initial measurement and there is subsequent measurement. All right, so that is that. So I'm going to split the board into two here in terms of dealing with measurements. And I'm going to talk about initial measurements. And I'll talk about subsequent measurements. All right. So let's look at the initial measurement. Now, of course, if you read the definition well, you see that there is a right to use aspect of it, and there is a part that money has to be paid, all right? So in terms of the right of use, we have two things. In terms of the initial measurement, we have two things showing up here. We have the liability component of it, and we have the right to use component of it. It's an asset, but the identity or the name given to such asset is called right of use. But I would advise anytime that you need to identify a lease, you start with the liability first, because the component of the liability forms the first line of the right of use. All right, so always endeavor to go through the valuation of the liability first, okay? Because the sum up of the liability is the first item on the right of use component. So let's start with our liability. Okay, so in terms of the liability, the standard says that the lease liability is actually measured at the present value of the lease payment that has not yet been made. All right, the key is not yet been made. So we say, number one, it is all about the present value, the PV, all right? It's measured at the present value of lease payment. Of lease payment that have not yet been made, all right? It means if it has been made, then we are using the figure, not the present value, all right? So that is that. That is that. All right. And we are using this at the implicit rate. All right. At the implicit. So our discount factor is actually the implicit rate. All right. Okay. So that is that. And it's for those that have not yet been paid, not yet been paid or made. All right. Okay, so that is that. And here we are talking about fixed payment. Of course, if you've gone to rent somebody's apartment or anything, you see that you'll be making fixed payment. My mom used to give me a small booklet that I will take to the landlord. Then back in Kumasi in those days, and rent were paid in arrears. Okay, so you stay in the month, then at the end of the month, you take that cardboard sheet to the landlord, and he would take the money and sign the space. All right, so that is how it is. Unlike these days, people want to take all the money in advance. So that is that. So we have the fixed payment, and let me say that you need to less any incentive. All right, fixed payment less incentive. All right, sometimes when you pay, they give you some take back. All right, so you need to less down from the fixed payment. All right, then we have any other variable payments. Yeah, these days variable payments has become of much essence because of the exchange rate. All right, so that is that. We also have residual value guarantees. If you guarantee that at the end of the term, you are going to actually buy the asset, that value that you have guaranteed, the residual value guarantee, you have to PV it, all right, and add it to the asset. Okay, and we also have options, and these options we are talking about when it is reasonably certain that you will exercise the option. All right. So the key here is that sometimes the asset useful life may exceed the lease term for which you are leasing it. All right. Now you may be given an option to extend your lease period. All right. So if it is reasonably certain that you extend it, then you need to PV it in addition. All right. Then lastly, we want to talk about any termination penalties. All right. Termination penalties. All right, that you may have to pay. All right. Okay. So these are the items that you have to PV to obtain the PV, your lease liability. All right. So it's very, very crucial. All right. So that is that. The next thing we need to do is actually go through and talk about the right of use itself. The right of use assets. All right, the asset that is being used. Okay. So in terms of valuing this one, you said that the initial measurement is always at cost. All right. So initial measurement is at cost. And when I say cost, by this time you should be able to know the element of cost, especially after going through IAS 16 with me. All right. So that is that. Okay. So I mean, and this cost comprise what we actually done. So the initial measurement of the liability, this is why I say that always do the liability first, because whatever you get here forms the first line under the right of use. Okay, so that is that. All right, so that is that. Now, again, any lease payment that is made at or before the commencement date is also part. All right. So we say payment made at or before commencement date. All right. So know that, I mean, this time it becomes part of the cost of the asset. All right. That is why we made that payment. Okay. Then we also have initial direct costs, just like we had in TP, initial direct costs, and any future dismantling cost. All right, dismantling cost. Okay, so these are the the things that you need to go through to determine your initial measurement on the lease. All right, so take key note of that. Right, before we talk about the subsequent measurement, I want to bring some issues up in the subsequent measurement. A key one of them is the lease term. All right, because we are going to go through the initial, the subsequent measurements by determining the things that will appear in the P&L and the statement of financial position. All right, so the lease term become of much essence. And we say that the lease term should be non-cancelable, all right? We're talking about non-cancelable period. Non-cancelable periods. Okay. Now, if you are going to extend the option that we spoke about, then it means that your lease term is actually a time that will include the option to extend, all right? If it is reasonably certain that you extend, that extension period becomes part of the lease, all right? So we say period by an option to extend, all right? And here what the key is that it has to be reasonably certain, all right? It has to be reasonably certain. There should be a reasonable certainty, all right? So that is that. Now, what you need to also understand is that a period covered by an option to, terminate the lease if they are reasonable certain that it will not be exercised, all right? If you not exercise it, okay, the opposite of this, if you will not exercise it, then, the periods covered by the option to terminate the lease is also part, all right? Period covered by option to terminate. So far as you are reasonably certain that the option will not be exercised, all right? Terminate. Okay, so that's it. And be careful. Sometimes, so I advise students that you may have the lease term and the right of use may have its own useful life. All right, in this case, if you want to get how to do your depreciation to present the item in the P&L, then you have to go by the lower of the two, all right? The lower of the lease term or the useful life of the asset, the lower of the two, all right? Okay, so when we are looking at the subsequent measurement, then the things that we are looking for are things that will appear in the P&L and also the SOFP. Now, in every lease, what you will see reflecting in your P&L are majorly things like finance costs, because it's a liability, so you have some finance costs here, and also depreciation, okay? Depreciation, all right? So that is that, okay? Now, in the SOFP, we would need the carrying amount of the right of use asset. We will need what has to be in our NCL and what has to be present in our CL, all right? So that is that. So in the initial measurement of the liability is what we have, but the subsequent measurement of the liability is the subsequent measurement of the liability is the finance cost that will be debited to P&L, all right? And don't forget, we have lease liability, All right, those are the subsequent measurements. All right. Now, as to the right of use, we will be looking for our depreciation. All right, and that is where the useful life and the this concept comes in. Okay. All right, so that is it. You don't, depreciate an asset over its useful life. Yes, you can't do that. All right, so you are always to pick the shorter of the useful life and the lease term. All right, so kindly take note of that. All right, how do we fish out these things? As for the depreciation, so far as you have the right of use initial measurement, we can now go ahead and apply our depreciation concept. So there is a table that I'm going to draw for you because sometimes leases are made in advance, sometimes the lease payments are made in arrears. All right, so I'm going to give you the two postures of it. So we have payment in arrears. And this is how you start. You have your year. You need to go through and have your year, let's say year 1 and 2. And most of the time, you just have to do up to 2 years, all right? Then you have your balance brought forward or balance brought down. And this balance brought down is actually coming for the first year as the initial measurement of the liability, all right? So we need to take that, all right? Then you have the interest that you pay, okay? The interest that you pay, okay? And this interest is the implicit rate at implicit rate. Okay, so that is the figures that you are going to get there. Remember, these are where you get your finance cost. Then you have your payment, which is a cash flow item, which every time you need to pay. So you have to reduce your liability by your payment. Okay, then you now have a balance carried down. All right, so what you're going to go through and to understand is that this bit becomes your NCL. All right, that is your NCL. And the difference between these two is actually what is giving you your CL. All right, so that is that. Now let's look at when payment is made in advance. The payment is made in advance. Then you have your year 1 and 2, and as usual, these things follows in here as your balance brought down. Okay, so it's still the initial measurement of the lease liability. All right, and instead of the interest, payment will now be made. Okay, so you have payment. Okay, you have your payment. All right, and it's a payment, and therefore you're subtracting, and you have some subtotal. You can bring total into this one if you want, but I believe that you'll be wasting much time. So you have your subtotal. Then you now come and do the interest on this figure, right? On the subtotal figure. So that is where your interest will be done. Also at implicit rate. All right. Then you now have your balance carried down. So your balance carried down here will therefore be the subtotal here plus the interest. All right. So you get this. All right, most important. Now, what you're going to do to pick out your figures to your SOFP is that this bit now becomes your NCL, and the difference between this bit and this one becomes your current liability. All right, what you realize is that it is the amount that is to be paid in the following year, and therefore it is always equal to the payments. All right, so that that is that. As for the right of use, it will go through the depreciation system, all right? So basically, this is all that is under lease. There is nothing difficult. We need to now go through and start with the figures, how we will be computing it. So let's look at one or two examples, probably one in advance, then one in arrears, and see how we are going to tackle it, okay, and present it in our SOFP. All right, so let me pull up this question. All right, so let's look at my good friend Kezia. Okay. So we have Kezia entering into a 2-year lease for a lorry. It's been a long time I had a lorry. A contract or the contract contains an option to extend. I hope you remember things about option to extend for a further year. Right? Kezia believes that it is reasonably certain, all right, that it will exercise. So right there, remember what we said about the lease term. It means we will have these two. And because this one is reasonably certain, we need to add it to make 3-year lease. All right. Okay, so take note of that. And it says that the lease payment is 10,000 cedis per year for the initial term, which is the 2 years. So for the 2 years, she will be paying 10,000. All right, and 15,000 per year for the option. So this 1 year that we have here, that one is 15K. All right, so that is that. Then it says that the lessor immediately reimbursed. Okay, so this is what we call the incentive. All right, and it says that the initial direct cost is 3,000. All right, so I mean that is where the incentive offsets. All right, so that is that. Then we say the interest rate within the lease is not readily determinable, but there is an incremental rate of 5%. So this is our implicit rate. Now the question is asking us to show the subsequent treatment. All right, so that is that. To be able to go through the subsequent treatment, we need to first of all do our initial measurement. Okay, so how do we go through to do our initial measurement? Remember, which one do you start first? The liability. All right. So it means that we need to now do a PV of those ones that are yet to be paid. Okay, so that is what we have in here. Okay, so I mean, you will have your year. So it's a 3-year lease. All right, this is initial measurement. So we need to go through all the number of years. All right. Then you will have your cash flow. This year 1 is 10,000, year 2 is 10,000, year 3 is 15,000. Then you need to bring in your discount factor. We have 5%. So remember how you go about it: 1 plus 1 over all, 1 plus r raised to the power n. So that is what you do. Or so you'll be having something like 1 over 1.05 raised to the power 1 for the first year. All right. Or you can as well do 1.05 raised to the power minus 1, 1.05 raised to the power minus 2, 1.05 to the power minus 3. All right, these things can be written in this. All right, so And that is that. So you need to find the PVs, okay? So quickly, like you can see in here, we go through, all right, this. We have our PV to be done. Okay. So you need to find your PVs. And I guess this has been done for us. Yeah. So we need to just run through quickly, because I'm much interested in the subsequent measurement which we brought up. All right, so this is how it looks like. All right, so this is how you go through. Okay, so that is it. So you have your cash flows, you PV them, all right, then you have. So this one becomes your initial measurement of your liability. All right, so if you want the right of use herein, right of use assets, then it is going to start with your lease liability, which is giving us 31,552. The question said that there was some direct payments that they were made with, and direct payments, all right, and which amounted to 3,000 Ghana cedis. Okay, so there was a 3,000 and there was an incentive as well. So you have your 3,000 as part, and the incentive that was given back, which is 1,000, we need to take that one. All right, so when we sum this in up, we will be having 33,000, I guess, 552. All right, so this become our right of use asset. All right, so that is that. The depreciation for the asset is going to go through for the lease term, all right, including the additional year that they deem to extend. So you have 3 years for this. Okay, so let's just quickly go back with what has been done in terms of the solution. Then you can have it, because we really want to move at a faster pace. All right, so that is that. So that is that. So you have your 33, yeah. And in passing your transaction, you have to debit. Remember, you debit your right of use, okay, with these ones. So you have this, you have this, all right. So that is that. Okay, so you will still end up, because this one is here, you still end up here. The 1,000 is a cash flow item. You have your lease liability. This one is a cash flow items. All right. So that is basically that. Okay. If we are going to draw a table now for the lease, then we need to know as to whether it was paid in advance or it was paid in arrears. All right. As for the question, to determine our what do you call it? To determine our subsequent measurement. Okay, so that is what we need to go through and do. All right. So that is that. We need to now come and see from here. This is the question. Let me open a page for us to deal with. the subsequent measurement. Okay, so let's set up our lease liability table. And this is a typical case of arrears payment. So in arrears, and if we are having it in arrears, then what we need to bring in, so we have our year, we have our opening, or our balance brought down. Okay, and this, since this one is in arrears, we will have our interest. The implicit was given at 5%. Then we take off payments. Then we have our closing balance. All right, so we have our years 2011 and we have 2012 here. The opening balance is that of the lease liability. All right, so don't forget, and we had 31,552, not the one of the asset, but the liability. If we are to conduct 5% on this, I think we are going to get 1,578 rounded. Okay, the lease payment for this particular year was 10,000. Right? So we need to subtract it from it, and then have 23,130. This now becomes our opening balance to this place. So we have one. All right, striking 5%, we should be having 1 point. Then we have our 10,000. And at the end of the day, we have 14,200. Remember, this one becomes our NCL. All right. Okay. Then the difference between this and that here, which is our CL, we are going to end up also having like 8,843. All right. And these ones form part of what we call our finance cost. All right. So for the particular year 2011, this is our finance cost. All right. So we are going to go through and also find our depreciation, which is also very, very important, depreciation. Okay, so we realized that the ROU was giving us 34,552. All right. 34,552. Dividing it by the useful life, which is 3 years, will be giving us a depreciation of 11,517. All right. So I mean, in our P&L, statement of profit and loss, I think we will have our finance cost for 2011. So we will have our 1,578. We will also have our depreciation. Okay, then that one too is 11,517. Since these ones are expenses, we can put them in bracket. All right, when you go to the SOFP, what are we going to do? What is the CA of the right of use? What are we having there? We have the asset to be 34,552. We need to take off the depreciation for that particular time, which will end up somewhere 23,035. All right, so that is that. On the part of our NCL, we know the figures that we are picking. So we just need to pick. So we have 14,287. And in terms of our CL, what we are looking for is the difference which we had, and it is 8,843. All right, so this is how a lease works. Not difficult, you just have to be able to find your figures, all right, as requested of you. It's very, very important. Okay. All right, so that is it for lease. We just need to take probably an additional question and also try as much as possible to deal with it. All right, so that is that. Okay, so let's go to our manual and see if we have a question that we can actually tackle before we bring this class to an end. All right, so let's look at illustration 8. With its solution. So you see that Mr. Ansah entered into an agreement. The term of the lease are as follows: primary period of 4 years from January 2012, and a rental payment of 2,000. All right, payable 31st December each year. So the fact that you are paying this thing 31st December means that it is in arrears. All right. So we have the PV of the lease. Oh, so it has been done for you. Lease liability payment has been done for you. Interest rate is this. Okay, so what figure should we show? So straight away, you have your rental payment. So all you need to do is to go through and do your lease liability schedule. All right, so that is that. I think it's been done here for us. Okay. Okay, so you go through, you do your analysis here. Most of the time, it's advisable you end it at the year 2, all right? So because you get your figures in the second year, all right? So this will be NCL. The difference between this and this will be your CL. And the finance cost for the period is actually this, all right? So it's as simple as that, all right? Okay, so let's actually find a question here and deal with it. Illustration 9. All right, so let's go through illustration 9 and we can close for today. So what the question said is that they have equipment for a period of 5 years at start of the financial year. On January, initial payment. All right, so check the timing. Okay, check the timing. It's very, very important. Requirement is in 31st December, and on 1st June, the initial payment has been made. All right, so that is that. So this one should tell you that these things are in advance. All right, so you should know that. So you have a series. It says that on Fenja, and then a series of four future payments. All right. Remember what we talked about in the initial measurement. We said that PV of the lease liability that has not yet been paid. All right. So these are the future ones. You can see clearly that the thing is 5 years, but the first year has been paid. All right. So that is that. You need to you go through and say that the implicit rate is 3% and the present value of the future lease is 14,000. Now remember, this is the 4 future payments. So the future payment that you see here is just for the 4 years. Because this one is done in the first year and it is in advance. You need not to pivot. Remember your initial measurement. All right, so that's that. So if you are going to go through and find out the figures that will be in the SOFP, what we should understand is that the PV of the lease liability, all right, is going to be our 4,000 plus our 14,860. It should give us 18,868. All right, so this form part, this is our initial measurement. So if you are going to draw our lease liability table, we need to, so you have your year, you have your cash flows. All right, so note that, which is your balance brought down. All right, so let me write it well. Let's set up the table. You get the figures. The key bit here in this question is that the first payment was made at the beginning of the year. You need not to PV that. All right, so it's an advanced thing. So you have your year, and you have your opening, which is your balance brought down. It's in advance, so payment comes first. Then you have subtotal. Then you have your interest and your balance carried down. All right, so let's go back to the question. This table has been designed already inside the solution manual that you have. All right, so this is how the table should be set up. All right, so if you go back here, you see the table being set up here. So it is the 18,000. All right, be careful. Be careful. All right. The fact that the 4,000 was paid earlier doesn't mean it's not part of the liabilities. It is. All right. So he says that, look at this note. The balance before its figure in the table is 18,000. Is the sum of the initial 4,000. All right, which they did at the commencement before this one comes. So you have your balance before in here. All right. So because it is in advance, you take off your payment. You get your total, then you work your 3% on this figure. All right. So when you are done, then it means that you have these things put together to give you these figures. You continue from here, you go on, and you do it from here. All right. The moment you are done, remember this one is in advance, and therefore your NCL is here. Your CL is actually this money, because that is the difference between this one and this one, as we instructed. So this is it. All right, and have this. When it comes to this component of it, you see that you have your 14 times plus your 4, which gives you this. All right, and you need to find your depreciation. Remember, it was a 5-year, so you have to go through and do 16, 18, 86, 8 all over 5 years, and it's going to give you 3,774. All right, so that is what it will give you. Okay, so that said, you need to now come back and less it from this figure, all right, to get your carrying amount, for which is done here. So that's what you see. So this is how you generate your figures. All right, you generate your figure. It can come as a question on its own, but be careful. Learn the things under the present value of the lease liability. Is those parts that have not been paid yet. All right, so you have to add the one that has already been PV'd in the current year. All right, and you set up your table, you are able to get your figures to represent what should be in the statement of profit and loss, profit or loss, then your statement of financial position. All right, so be very vigilant about it. Lease is the most easiest of all the standards. You will do well. So God bless you. I'll meet you tomorrow, and we will try to look at more of the IAS standard. We'll try and look at IAS 12 tomorrow, as well as IFRS 15. All right, so God bless you and see you soon.